Hey, left, right, out. We're just at the market close today. It's Wednesday, the 31st. Over this last week, which I haven't done a video or anything, we've seen the market really take a dive, and it came after Chairman Powell had his little speech there, pretty much stating it was a very hawk, is a more hawkish tone than we're used to. I don't know if you heard me there, but it's more hawkish tone. Powell was a little bit like saying they're going to do whatever they need to do. And there's going to be some pain. They're going to be tighter for longer, essentially, and things of that nature. A little bit more so that what people were more looking for, either steady she goes, or like the whole pivot play. And he came out there, and then now we have some other Fed officials coming out, and some mentioning a 4% benchmark rate and no cuts over to past 2023. I think they're woefully in the wrong. I don't think it's going to who cries uncle first, right? So are they going to allow us to go into a depression? Because all of this buildup from the years of inflation, which loose monetary policy, is coming to roost in a big way if they keep it up. So I'm not saying. See, one thing I was wrong. I said 1.25, and they wouldn't be able to do it. Well, I was wrong on that. And I just made a call, and it was not the greatest. Now, there was some companies that have gone bankrupt that haven't been able to access debt. You've seen a lot of these crypto companies unable to really stay stay afloat, and a lot of other little companies are either not hiring, and they're declaring bankruptcy in a number of ways. But anyway, so we're at 2.25, 2.5, and they're going to go up again in September. And the way they were talking about it, everybody's now kind of suspecting the 75 basis point rate hike. I mean, I kind of think half a point to 75 basis point if they're going to talk tough like this. It seems like that's what they're signaling. But either way, once you get into that 3-something% range, there's that many more companies that can't roll over debt. And that'll take a few months. I mean, we haven't seen the ramifications of the last few rate hikes. And granted, they're not in the impact of fighting inflation. What they are doing is making certain companies untenable through the debt markets. But anyway, so we had our massive rout. It was like 1,000 points on the Dow. A really good, I think I call it really good because I was short, and then I had to close out some of these. I wish I would have been able to stay. There's some rules that I do when I'm trading, so I had to close out a couple of the positions, but I have some longer term short through options positions that I have on still. But anyway, it was down. I think the S&P was down like 100 and something points. Today, we're looking at the last couple of days has been kind of negative. Today, we're looking at 31 points at the end of the day, which it's like, what is it, 1% maybe? I want to pull this thing up so I get it. 31 something on the 0.75% for the S&P, and then the Dow is down 280. Then you have some pressure on gold, which you would suspect that with the Fed. More than likely raising interest rates. You'd suspect that a little bit, but in reality, with negative real yields, what we'd think would gold hold up fairly well. But I'm hoping it sells off, to be totally honest, because there's a lot of good gold companies out there for when they pivot. I don't even call it pivot. When they go back to just printing money again, the balance sheet expands, when interest rates are pushed down once again, these companies are set to really take advantage, or really be in an advantageous position. So there's a couple of good gold companies I'm looking at, trying to get to those right positions when there's a big flush out. Anyway, there's a lot of other things that are going on, a lot of data points. When we look at the housing market it's cracked, and we've seen an actual, I believe it was a year-over-year decrease in prices, I think for the first time since like 2009 or something. It was something weird, some large number. Of course, we've had month-over-month price decreases. And then you've seen an overall collapse in mortgage demand. You've seen a collapse in new housing, which you're going to continue to see that kind of collapse, especially with prices of still inputs still high. But then you have this market those new homes aren't going to couple very well with the pricing of existing homes in this type of market. So I just expect some kind of rout there. It's just going to continue as these interest rates go up. That market right there is so sensitive, especially because now the majority of houses with 0% down or 3% down or whatever, they're so sensitive to the debt market that that you're going to see huge ramifications there, and you're going to also see people struggling because a lot of people bought in with prices everly increasing, and they don't have that much equity to play with. And maybe they do need to get out of there. Maybe they're going to lose their job or whatever, because there's a lot of companies now that are coming out and they're cutting workforce. Even though I guess the JOLTS report said something about a lot of, because I think that's the jobs one. Yeah, the openings. But those openings, I mean, I don't know. We don't know the details on a lot of them. There seems to be a lot of companies warning, and they have been over the last few months. There seems to be a lot of companies saying that they're going to lay off staff. And there has been layoffs in various sectors. Then you also have service sector stuff that's going on that's not looking too good. Anyway, it doesn't look good for the housing market because you're going to have multiple blows. Not only you have cost of actually getting a mortgage and servicing a mortgage, but then you're going to have these pressures on wage. Well, you already have real wage pressure from the disparity between rising wages and rising prices of goods and services. But you also have that when you have the jobs market itself cracking. So to me, we're in a recession. I mean, that's how the definition. We do have 2 consecutive GDP prints that are negative. Now, like, there's a lot of whole. We can go into those numbers, like how kind of there's a lot of fakery going on. But regardless, if anything, they're going to fake upwards and not downwards. So we're in a recession, and then you look at these other indicators of pessimism among people. I mean, granted, a lot of these are lagging indicators, or I mean, is it lagging? They're indicators that are people's perception at the time, and anyway. A lot of people are not feeling so good. There's a lot of there's a misery index. It's not looking too good. There's people's savings rates not looking too good, even with rising rates. Because typically, when you raise rates, like in a free market or whatever, when you have rates raising, it's an indication that you need capital, and people start putting their money to get a return, and then you build that capital to lend out, But still, savings rates are at all-time low, I believe. It's pretty close. Savings rates are low, way low. You have credit expansion, so that's kind of inflationary. You did have a balance sheet reduction a little bit last week. We'll see what happens this week. But that's really all I want to talk about on the market itself, because it's been good actually for me, because this is what I've been talking about. We needed that route. We should see the S&P pull down, hopefully, into the low 3,000s. I would think. I mean, that's just a kind of a weird call, but basically what I've said before is the market is a Fed pricing mechanism. So any Fed member could come out and say something and spark a huge rally, right? So they can pivot on a dime with just words. Will it ultimately affect the economy? No, because they're pretty much in a box. It's either damned if they do, damned if they don't when it comes to the overall macro level economic situation in the nation. They raise rates, they're going to snap something. We're going to possibly go into depression. They back off and they go back to like, well, they're already loose monetarily, but a loose monetary policy. And next thing you know, we have the inflation monster, or the rising prices, or it is inflation, but I mean the rising price monster rears its head back. And when you don't have the ability to offset that increase in monetary or demand side stimulus with supply, you have these rising prices, which we seem to be hindering ourselves even more with supply, with regulations, with the government being able to turn on a dime and go after certain industries, whether it be oil and gas, whether it be regular vehicle manufacturing, whether it be housing and too, whether it be just small businesses, whether it be they're involved in healthcare, they're involved in college, where you have the $10,000 forgiveness, whatever deal that Biden's trying to push through, which is inflationary in itself because that money exists. And what it does is it opens up additional purchasing capabilities of those people, and you're not even paying those loans back. So essentially, you destroy somewhat of that money, but then you open up people with more purchasing power. I'm not saying that it's not good for them. I mean, if you almost stupid not to take advantage of it if they're giving it to you. But anyway, so there'll be additional demand in different services because of this, and It's all crazy. Instead, I mean, to be totally honest, I'll give you what I would think is best for the colleges, and I've floated this out there and had some really stupid responses against it, but is to allow college debt to be liquidated through the bankruptcy system, pull the government out completely, allow a robust lending market, or allow lenders to maybe won't be robust. Maybe there's no economic value in lending to them. But what you'd see is like some of these degrees, like whatever underwater basket weaving or gender studies, you wouldn't be able to get a loan for that because there's no real return on that at the end, and there's no real return on capability of the bank to really get paid back for that. So that I don't know if there'd be a disparity in pricing with certain study groups, or you'd have severe cuts in colleges for certain programs and more emphasis on programs to get a real return. Like, say you wanted to be an engineer or something, a bank would probably write a check on that, knowing that you will have the capability later on to pay that loan back. So you'd have more of a robust free market system with it willing to lend on majors instead of just blatantly just giving people financial aid. These lenders would probably ask, well, okay, well, what is your plan? Bam, bam, bam. Okay, you're going to be an engineer. That's cool. Well, we're willing to loan you this amount of money and at this rate if you can pay us, and we expect you to pay us back. And you have that kind of action going on there instead of, or you have companies. Let's take the medical field. There's been a little bit of this going on where companies are actually able to backstop people's medical degrees in order for the or the VA does this too, but I mean, I'm talking about like private sector stuff, so that those doctors or nurses or whatever will come on board of the company and work directly for them for a number of years. So they pretty much a contract, and they pay for their school. So there's a number of ways the free market can handle this and actually put the right amount, put the capital investment in majors that actually produce economic value instead of, in what, like I said, underwater basket weaving or gender studies or dog mating habits actually might be something of economic value. But I mean, there's a bunch of other ones that people are liberal arts or whatever, whatever the flavor of the day is for a lot of these guys that are perpetual students or working barista fields with $100,000 worth of debt, psych majors or whatever the case may be. Point is that if you allow a free market in these systems, you'll see the capital go to where it needs to go, and you'll see a lack of capital and where there is no real return on there, no real advantageous positioning or no real economic value. So, and then if, like there's risk in any lending venture, there might be people that flunk out and they have to declare bankruptcy. That's a risk. So there will be certain things they'll look at, like how good, another thing we're lending, if that came to pass, if there was a free market and they were lending against things, they'd probably look at your high school records too. Like, okay, well, you got A's in high school and you did well on AC or SAT, or or maybe you couldn't afford that, but you did really well in high school. You participated in stuff. You show that capability of being a responsible person. Yeah, we're willing to give you a loan at this amount to go into, I don't know, you want to be a physician assistant or something. Whereas somebody, oh well, you coasted by with C's, you barely, and you want to go to college to become a sports whatever broadcast journalist major, we're probably not going to lend you that money, or if we do, it's going to be a significantly higher interest rate, and there'll be less lenders in that market, so there's less capital, so there'll be less students going into that field, and presumably more students, or the capability of more students to go into the more productive field. I mean, there's a lot of it's an interesting thing. It seems like a small easy fix that just never has it just doesn't have any lobbying or any political, I guess, there's no advantageous position politically for anybody to profit from. And, the colleges and their endowment funds and whatever, they're big lobbyists, and they've got big pool on a lot of politicians and aristocratic apparatchik of DC. So anyway, I'm going to leave it there. That's an interesting talk. Maybe we'll go into that a little bit more. Probably going to do some movie reviews and some show reviews, because there's some interesting things. Hollywood's kind of like almost like one of the canaries in the coal mine of overall civilization. It's been one of the things that we, movies and art has been one of the things has been the pinnacle of our, I guess, call it empire, our United States as a empire. Promoting our culture across the world and giving people, and we've seen now Hollywood as like a almost last bastion of things that we were on top of, and in industry was culture. We've seen that kind of like take a deep dive. So now I'd like to look at some of those. Like we went over Maverick, which is an excellent movie. I think I'm going to do Terminal List next, which is another excellent movie, and then we'll go down the rabbit hole of these really horrible shows that they've destroyed perfectly good scripts that were already written for them. But anyway, talk to you later. Peace.